Ladies and gentlemen, welcome to another episode of Don't HR Alone, presented by People Processes. I'm your host, Rhamy Alejeal, and today we have Van Carlson. He is the founder and CEO of 831b.com. It is an SRA that's been around they handle SRA plans, been in business over 30 years, doing that for 16. They are the number one provider of that in the United States, and Van is the founder and genius behind it all. So we're excited to have you on, sir.
Yeah, thanks, Rhamy. Appreciate the opportunity.
It's my pleasure. I've been very interested in these. This is one of those things that you see, you may have first heard about an 831b plan from a tax advisor, or if you're like me, you saw it on TikTok. You can save thousands in taxes with this crazy scheme, right? But I do know there's a lot of truth to it, and there's a lot of valuable opportunity. But I wanted to bring you on because I think there's also a lot of people out there doing it way wrong. I wanted to really talk to an expert about it. So give me the ballpark. You're meeting a guy, he's got 20 employees, maybe a 2 million in revenue. This is the small business starter. What the heck is an 831b plan? Why should they even be considering it?
Yeah, so an 831b plan is really like a 401k plan, meaning that it's part of the tax code. It was introduced in 1986, and it really has to do more with business owners that are self-insuring risk. And one of the things that we talk about when it comes to, we talk about risk financing, right? So if you're running a business, traditionally you like, for example, let's say you're a manufacturer, you got product liability, you got general liability, you got business personal property, and then let's say you're renting a building or you own the building. You got commercial vehicles, all of those things. You're buying traditional insurances for those, and you're risk financing that through paying a premium. Some will pay it annual, some will pay it monthly, right? I mean, meaning that you transfer the risk to an insurance carrier. You got a policy for that in turn, and you transfer the risk to them for dollars and known as premium. And then there's things on there on the books that you're just going to retain on your books, and then it becomes an unfunded liability. And then it comes down to, how do you want to fund it? You want to use pre-tax dollars or after-tax dollars? And after-tax dollars is just cash flow of the business, capital you put into the company, and now you're utilizing it with unexpected expenses. Pre-tax dollars is utilizing an 831b. And that's literally what happened in 1986 when the Tax Reform Act came in. And the 86 Tax Reform Act was by far the biggest reform act in decades. And it still is to this day. Nowhere near came to what 2017 Tax Reform Act. 86 was a very big, impactful to the taxpayers in the United States. A lot of changes were made, but they were also introduced this code then too. But what was happening back then was a lot of business owners found themselves self-insuring risk, not only a lot of times due to traditional reasons, but also farmers were finding themselves self-insuring crop insurance. And now it's heavily backed by the federal, it's a backstop by the federal government today. However, that wasn't happening back in 1986. So that was an incentive, basically for business owners to use pre-tax dollars they would have sent to Uncle Sam. They're just going to allocate those dollars, still expense them into operating company level, and then drop them into an 831b. 831b really becomes its own entity. It's a C corp. It elects under the 831b tax code that allows any premium you put into that not to be recognized as taxable income. The only thing that would be taxed under that entity is realized investment gain. So if you put a premium dollar into a money market account, for example, you're going to pay taxes on those realized gains. We're the administrator of those plans. So we're no different than the 401k administrator you would hire to administer your 401k plan for your employees and for yourself. You need somebody to stay in the lanes. You need somebody that knows the rules and regulations, all those good things. You would never administer your own 401k. First off, there's too much liability to it, honestly. Right. Very similar to 831b. There's qualifying tests. There's minimum, maximum contributions. There's who can own these things. There's a litmus test of things you go through, and then the big 4-part test that you have to have in order to elect them to 831b.
Before we get into that, before we get to the kind of nuts and bolts of it, let me knock it back down to more the layman. So my business, I run an HR company, right? So we've got 40 employees. We are doing business in 50 states. I provide MacBooks and laptops and all kinds of stuff, maybe $4,000 worth of equipment for each one of them. I don't have a commercial auto policy like maybe a plumbing company, but that's my capital investment. Of course, we have office rent, we have all these other things. And for those things, I get insurance, right? If somebody, I don't,
Yeah.
yeah. I also have things like, I don't know, business continuity insurance in terms of like if my office burned down, right, that covers my rent and in theory would cover business continuity, but we've all moved to being cloud-based now, so that's not really a risk. I have a risk that my software providers will, go out because of a cyber attack, hacking, ransomware, whatever.
We call that third-party business interruption for sure.
Third-party business interruption. All right, so I have that risk. And to my knowledge, I don't think that's really covered by my insurance. I think
it's not.
My insurance right now, I have a cyber liability, but I think that's more, I don't know, if my employees try to...
I mean, I've been in risk management so the cyber policies today are this, unfortunately, it's good that you have one. A lot of business owners don't. A lot of business owners get a business operating policy, and what it is a package policy. And the problem with policies is you get all these sublimits. I mean, most of your employer liability practices are going to be about $50,000. Your cyber is going to be about $50,000, and they think they got coverage. And unfortunately, it's
nowhere near
the bucket. Based on today's world, doesn't matter what size of company you're in, by the way.
But that sort of risk is what I have. I have all these risks.
Well, and too, I would say you have professional liability. I assume you have professional liability in place. Yeah. We look at those policies and we kind of dive in. What's happening today, based on the stress of the market, and you've probably been seeing your rates go up. A lot of business owners are seeing their rates go up all over the country, and it will continue to go up, unfortunately. Very similar to what gone on in the 80s, what's going on today. And what's happening is you're paying more and you're getting less coverage. So we're seeing a lot of sublimits come in, and we're seeing a lot of exclusions. So one of the things that we'll dive into with business owners, we'll do a full underwriting at no expense to the business owner and say, hey, here's your gaps, here's your coverages, because you don't know how good of a policy you have until you have to use it. Well, the problem is that it's just, you don't want to know the back door's wide open and you thought it was closed, right?
That's right. That's right.
That's risk management. And
so that alone is a high value that you can serve as a risk analysis for what's insured and what's not.
And honestly, AI's done a great job in that space for us to be able to dive into a contract. And so that's been really, we can get it done pretty quickly, I guess, the point I would make there. But so all that aside, I mean, I look at brand protection today. It's huge. Cyber, you have a cyber policy, but a lot of times it's just going to do a credit watch on the people that were compromised, but it's not going to do anything for your brand. And unfortunately, your reputation in the community will be compromised. We've dealt with it. We dealt it with a lot of different business owners, and it doesn't matter what business you're in. And we've had it to where W-9 people or W-2s were compromised to HIPAA. Where people got, things were let out by, and we know cyber is about 90% employee failure somewhere along the line, either lack of training or on purpose. We've had those situations where we've had disgruntled employees do stuff purposely. So those are all reputational rebuilds. And I call it the double negative. If those things are going on, you have a compression of new dollars, you could be losing clients. You can not getting the market share you're used to. But also you got expenses going up, and now where's the money going to come from? And that's really where the 831B can make the difference, Rhamy, for all business owners. And it's because, I call it a war chest or a rainy day fund, right? You hope it's a rainy day fund, right? Where now it's backstopping areas that I thought I was covered on and I wasn't. And now where those dollars are going to come from. And that's really that's what the code was written for.
So I've identified a risk. We figured something out. For me, it's maybe my cyber liability isn't quite up to snuff. Maybe I may not.
Exclusion on professional.
Yeah. So we've got that figured out. Now you do that analysis and you say, okay, this is the risk. Why am I setting up an 831B? Like you're saying pre-tax. Well, my insurance is pre-tax. It's a business expense, right? So what is different about an 830? Like, why am I setting up my own insurance? Basically, instead of just going to Lloyd's of London and saying, write this, dude.
Yeah, no, it's a great question. So what you're going to do, though, is you're going to still create an expense at your operating company level, right? So when you pay that premium into an 831B, you're expensing that under the 162 line item, no different than you are, to your point about the professional liability on cyber. It becomes a necessary and ordinary business expense. Those are your dollars, though, right? So that now becomes into the 831B plan. It's a C corp. You own the shares, and
There's some record keeper. You're the record keeper.
So that's where we come in, right? So it's going to have a tax return done every year. That's part of all of our admin fees. We don't complicate the business owner's lives by no means. It's an education level really for the first year or so with the business owners, and then once it's trained on the tracks, it's going. But that's really where the advantage is using pre-tax dollars, right? So meaning I can still expense them at my operating company level, and think of it as a savings. One of the reasons I really got into this was in 2008. When I up until then, I was running a successful property and casualty agency. And unfortunately, when the Great Recession hit, I saw a lot of my business owners go out of business. And I always jokingly talk about the fourth quarter, but it was true. I loved the fourth quarter because they would call up and say, "Hey, Van, my CPA says, oh, money today. What is it going to cost for another truck and 2 more skid steers," right? Or whatever. And all they did was took advantage of acceleration, but all they did was bet next year was going to be better than this year because they leveraged and financed, and they were able to take the tax deductions, right? So I saw that a lot. It's like the big tax planning. Well, spending money to save money there's some fallacy to that, right?
Right. Could be a bad move, yeah.
And so I tell business owners, you've never had an incentive to save money. This code gives you that incentive. Why? Because you can still expense it, but you still have control of those dollars. That may be the only dollars you have available to you when the world turns against you, either due to economic reasons that are beyond your control, or due to what's gone on in the world of enterprise, where when you talk about in '86 when this code was passed, the world would be a lot simpler back in '86 compared to today. I mean, nobody cared about social media. Nobody cared.
Right.
You cared about your brand, but it wasn't like to the level that could be destroyed immediately because whether it's true or not, right? Because of what goes on in the social medias today. And so the world's got much more complicated. We're basically on a global economy with supply chain risk today. I mean, we saw that coming out of COVID, where a lot of business owners were in trouble due to the supply chain. And now, and by the way, that's just getting more complicated as the day goes on. So all these risks that we talk about that I brought up today, you can't buy traditional insurance. And by the way, they're not going to increase their appetite for that risk.
Sure.
The reason why the government had to step in on the PPP was, to your point earlier about the business continuous, that's an indirect loss. So if the government says, "Hey, we're going to shut you down," that's not a direct loss on your property. Like, for example, the fire on your building. If your building got flooded or whatever, and you got displaced, that triggers it in a business interruption because there was direct loss on your property. If there's not a direct loss, and that's another big key about third-party business interruption. We're all dependent on third parties now. I mean, if you have any kind of CRM system, any kind of cloud-based, they get compromised anywhere, shape, or form. You can't get into your system to operate. That's loss of revenue. It's a huge expense. You're still paying people to do nothing because now you can't dial in. There's a lot of that's a form of supply chain, right? I mean, that's an interruption in your supply chain for sure.
So we identify the risk, we talk about it, and we say, all right, you're going to save $5,000 a month. I don't know I'd love to get some numbers, ballpark stuff, and that's going to go to this 831B, your 401k at the record keeper. That money is under your control to the extent that you could invest it. You can buy Vanguard stocks with it. It goes up and down. If it's a money market or bonds, if it realizes gains, you're going to pay taxes on it, but it's basically just going to stay in there and grow. And then if one of these identified risks happens, I get the money back, or I insure myself. I get to take,
we'll adjudicate the claim, right? So that's another one part of the test. The last part of the test is acting in principles of insurance. That's, as your administrator, we're making sure this box looks and feels like an insurance company and it runs like. So there's got to be a formal claims process. All of those things need to be worked out. We do all those pretty turnkey on our end, obviously, because it's what we do. But, we kind of educate the business owners on that. But so you're absolutely right. These are 1-year policies, no different than the policies you're buying today, right? So let's say you come into the fourth quarter and say, "Hey, I want to buy risk for 25. It's 100. We just said, okay, we will always do. We have a actuarial methodology that we use. What you can do now. In '86, you can put up to $1.2 million a year in this thing. In 2017, that changed. It was being abused for estate tax purposes. If you looked at this code in the past several years, They've gone to court. IRS has challenged people in court with cases that were really in the late 2000s, early 2012, 2013. A lot of it's due for estate tax purposes. The 2017 PATH Act got rid of the lineal descendants owning these things, so that it became less attractive from an estate tax tool. But they also increased it to 2.2 million with the CPI rider. So, for example, this year, well, going into 25, it's 2.85 million is the max you can put in these things. That's the max. Well, there's still rules on top of that, right?
Based sure, it's got to be a reasonable revenue. Risk.
Yeah. And so typically we'll cap you at 10% of your gross revenue, no more than 2% per risk. So if you say, hey man, I can put, I'm a $2 million company, I want to put $200,000 away in this thing, we got to find at least 5 plausible risks that you have that you're self-insuring.
Right.
And then we're going to allocate dollars to that. So then we're going to expense those, issue you policies for that specific coverages that you need, or fill in the gaps under professional liability or through endorsements and all that. And then we're up and running. So you take the deduction, you put the $200,000 net of our fees, which we can get into if you want, and then the rest of it goes into your bank account under the name of the 831B plan as a C corp, right?
Kind of like a self-directed 401k, sort of.
Yep.
Yeah. You'll sign but it feels like agreement. That if you're familiar with it. Yeah.
Oh yeah, very much. So you'll sign an investment agreement with us, which you can and can't do. Reserves are money at risk during this policy period. We're going to ask you to keep those pretty liquid, which means stocks, bonds, mutual funds. That's
can't
still
buy a house with it.
Yeah. Yeah. Exactly. Okay. And then the policies expire at the end of 25, net of all claims, underwriting profit. Obviously, as long as those dollars stay inside the plan, they never become taxable. You as a shareholder can declare a dividend out on them, or you can shut it down the road and pay capital gains. The point is building that surplus on a tax-deferred basis. So now you're able to take on more risk too as you go. I mean, we're seeing more and more clients take on high deductibles.
Right. You could save money on their actual on their fully insured stuff.
Yeah.
And so at the end of the year, we got $200,000 in there. We didn't have a claim.
Yeah.
We now do this again next year, and there's 200 and another 200, but we're still riding the same risk, right?
Yeah.
And so I recognize then that's a way to accelerate a deduction, right? It's much that makes sense, and then it grows effectively tax-free until you get it. When I make a claim, is that taxable income?
It depends on how it comes into you. But typically, you wouldn't be expensing the losses, though, right?
Right. So I've lost some money.
Zero. Right.
Okay. So so just to clarify that, I lost 40 laptops. I'm going to expense the replacement of those laptops. I'll be getting the money for that out of the insurance.
Right. And it's making you whole kind of thing, right? Kind of concept, right? That's what insurance should do, is make you whole, right?
Exactly. What happens if it's 5 years from now, 10 years from now, we have $3 million in this insurance policy on a business that's still doing $2 million in annual revenue, maybe. I hope much bigger than that. But how does this wind down, and what does that look like? Or do you wind it down?
That's a great question. So a couple things along the line, though. So we start by year 3 and 5, we'll start doing solvency testing. So if we feel like your coverage for your based on the coverages we're covering you for on an annual basis, we're going to ask you to take a distribution, or we have to find additional risk and all that good stuff. So those kind of come into play. But let's say you sell the business 4 years, 5 years, it's a C corp, right? You can basically shut that down, move it off to a holding company. If you do that, you got to work with other folks. We don't do that. But if you want to shut it down, we'll do the final tax return and do the 1099 capital gains distribution to the shareholders. And I think it's a $3,000 shutdown that basically pays final tax returns and our admin fees to shut the thing down, and you pay capital gains on the money pulled out of there. So it's pretty simple.
Do you pay corporate income tax and then capital gains, or how does that?
So you only pay corporate income tax during the years that you have realized investment gains. So it's like I was saying earlier with the money market accounts, right? So if you got, let's say you put 200,000 in, you got 5%. So what is that? 10 grand. So you would pay 10 grand that year on that corporate taxes, right? On the 10 grand, the premium's never been taxed.
Right.
The premium would be taxed though when you bring it out as a shareholder. It'll be taxed in the form of a dividend or capital gains. Both of those rates are the same, And, we tell our clients, obviously, we don't know what that ball does get kicked around a lot.
Yeah.
And so, we hope they win on that. Based on our fee structures, they would win today based on, and it too, really honestly, that's where we work with a lot of other trusted advisors that they have around them to, hey, how do you strategically, make this work, for business owners and maximize all the advantages to it. We stay in our lane. We manage the plan. Once that money, let's say they sell the business and they say, hey, we're just gonna re-domicile it and it's not gonna be an insurance company. That's great. We're gonna, we're no longer your manager of this plan.
I see.
Somebody else will go manage it and go do those things. So that's one way. Or do they just simply shut it down? That's really what it comes down to, Rhamy. It's not we have been accused of making this thing sound like a rocket ship, and we're trying to avoid that. But it's not easy to do sometimes, right? I mean, it sounds complicated. But honestly, I think we've made it as simple as we can with our business. And the reality is, our business owners, you've been in business long enough, one of the biggest things we deal with is dispute resolutions, meaning that I'm just simply being sued. My GL's not covering me for it. And now I'm being sued and I'm coming out legal bills. And today, man, it is no joke. If you're in business long enough, I don't care what business you're in, you're going to get sued.
You're going to get sued.
We've for a loan, right? EPLI. We deal with EPLI. We deal with EPLI a lot here. Mm-hmm. One of the things that was been interesting to us to see, and is the disruption of the business. It's one thing to pay for the legalities and okay, now I got to have a judgment against me, whatever, and you have an EPLI policy for that. But it is a big business interruption to businesses, especially.
A lot of our clients or people who haven't worked with us or haven't been through that have no idea. But at our company, we serve as the HR department for other companies. And it's like the lawyer doesn't know everything. There is no documentation that magically happens. When you get sued, the data retention, preparation, gathering everything, putting the narratives together, interviews, that whole world is tons of time. And it's not free.
And the culture effects. The culture affects it to your business. And then like I said, the business interruption is real. So one of the things that we do is when we offer an EPLI policy, we piggyback on their business interruption. We go back and look at 3 years. Hey, this lawsuit started on this day. Maybe it was a salesperson. Maybe it was, what doesn't matter. We can go back there and trend that you've lost income. Not only have you had this, and then too, the psyche of the business owner sometimes. These people. Yeah. So, we've all, I know we've all been.
It's exactly it. It's just you feel betrayed by
Yeah. We've been doing this long enough. You have stories, right? Or, some really sad stories. It's just, the financial effect though. And so what's one of the things that we've really, when we sit there and watch this happen and say, okay, well, we got to build a risk policy around this because this is real risk that business owners are retaining. That God forbid if the EOCC or the commission came back and said, hey, you can bring a lawsuit against your employer now. Man, can be devastating to business owners. I mean, I've seen it, and I'm sure you've seen it too. So it's just,
I'm thinking about one right now. We're going through some pieces that it's totally the two business owners. One of them is barely able to. It's like I just want to get rid of the whole thing because I feel so betrayed. The other one's got a bit more experience and is like, this is just part of doing business. But that it's such a sap on the wind of the business, and it has had a definite effect, in my opinion. Looking out over their last 9 months since this really started, their rate of growth has slowed. Highly measurably from a risk perspective because the ownership team is completely consumed with this.
They take their eye off the ball, right? I mean, how do you not? And so, and that will relate to business interruption.
Exactly.
And so, again, these are things how do you want to risk finance this stuff? And here's the bottom line to your point. You don't want to, I hope to God, if you have to use these coverages we're talking about, you're not having a good day. But honestly, that's true for any insurance.
Right.
I mean, I can't think of any good situation where I got to call up, hey, I got to have a claim today. I'm really having a great day. It doesn't matter what claim, broken windshield on your car to a fire in your business. I mean, none of it's pleasure. Right? So, but in our situation, it definitely goes on to a whole nother level too, because I mean, this can be the difference between having a business or going out of business, honestly.
Right.
And if it hits you at the wrong time, you got too many receivables out, you got cash constraints, and all of a sudden you got these additional expenses coming in over the top of you. It just puts your business more at risk. And don't kid yourself. I mean, Congress needs your business to stay afloat.
Right.
We need revenue. We need velocity of dollars. I mean, this is what small business, what drives our economy and makes it one of the strongest economies in the world, and be able to do what Congress does, right? They need these small. So that's what they're incentivized to have. All business owners have these types of tools available to them, and I would just tell you from we've gotten really good. Just so everybody knows, I mean, we got a lobbyist group, and we're getting really, we got to educate a lot of folks because they didn't know about this code because it was almost 40 years ago it was passed. We've worked really diligently in the last 3 to 4 years on that. On both sides of the aisle, I would tell you, they're both proponents of this. They see it as a great way for business owners to take advantage of it. Most business owners are bootstrappers anyway.
Right.
And they did it. This just adds that value to them, meaning that this allows them to go do their own risk management. It allows them to build up their own tax-deferred bucket of money and allow them to spend the money where they need to spend it and at what time. Because, COVID was one thing, but there's a ton of business owners, and we've kind of hit on a couple of them already about risks that they're happening today, that they either got to go to the bank, get a line of credit, or get a second mortgage on their house, or decide to shut their doors, keep their business because they got an unexpected expense now hitting them where they either thought it was going to be covered by insurance or that it was never going to be covered because we had this outlier of a situation happen, but now it's dramatically affecting my company. And that's, like I said, I've been doing this long enough, man. I've seen where we made a big impact. We made a huge impact for clients of PPP as well, especially restaurants, anybody that was involved in the hotel industry. I mean, these guys got pummeled quickly.
So if our listeners are, here they are. They're like, all right, this sounds pretty good, but let's get some brass tacks for them.
Yeah.
In general, you need profit because you're wanting to minimize some expenses here. Are there any limitations in terms of this? You have to be an S Corp, LLC. Is there anything like that?
No, there's no limitation on the structure of the company. As long as it's, to your point, successful enterprise. The different industries we have is amazing. I mean, it's one of the fun things we do in our, we run across some people that do some really interesting things and they make a lot of money doing it, and God bless them for it. But that's been a fun part of our business. You probably see that too on your end. But really comes down to, it's a long-term plan and strategy. If you have a tax liability this year, but you don't foresee one having one, we're probably not for you.
Right.
That's highly tax motivated. Which, honestly, I would say when I first started, that was probably a big driver. But today, man, it's about risk management. I mean, more and more business owners are finding themselves really self-insured because of what's going on in the insurance market. I don't see that changing anytime soon. But it really comes down to like $80,000 at least per year is a minimum you can put into this. That would make it work for you as a business owner from a fee structure standpoint, honestly.
Sure. So if you're not looking at your books and saying, all right, yeah, 100,000 to some sort of risk mitigation, deferred expense or accelerated expense, kind of thing, 100,000, 80,000 is kind of the starting.
And that's not to say that next year something comes up and I can't fund.
Sure.
You can't do your own, but it's got to be a long-term thought process. This is not an in and out kind of thing.
Reminds me a little bit of the discussions I've had at times about, defined benefit plans, some of the kind of, pieces on there. So you're looking at, so let's say you're a company, profits above 500,000, you're looking to mitigate 100. You recognize you have risks. Maybe it's more like $1 million. What would you say kind of is the smallest size that in profit that you really see people coming to? I know that you could be $100,000 a year group and do it with you and go, hey, no taxes. But what are you seeing?
Yeah, honestly, we don't look at profit because insurance companies don't look at profit, right? They always look at your gross revenue.
There you go.
And off your gross revenue. And here's what I will tell you: we will always tell the client the ceiling that that the max they can put into this based on our methodology. Anything below the ceiling, we're perfectly good with. Right. Again, just because it says you can put 2.8 doesn't mean you get to put 2.8. Right.
Right.
It has to be tied to it has to be an underwriting methodology to it. Right.
And you mentioned about 2% of gross sales
for coverage, up to 10% max. So 5 coverages. We don't, most of our clients won't max fund off. Or what I mean by that, they won't do the 10%. It depends
Sure.
on the business. It depends on the cycles they're in. That they're having a good year this year, they may want to go higher. If they have a lower year, they're obviously not. It's that every year as an insurer, as a consumer of insurance, you're picking your limits all the time, right? I mean,
Right.
especially when it comes to business interruption. And this was really we tied this program very similar to the crop insurance program. And if you're not familiar with crop insurance, which I don't blame if you are,
Haven't done those before. Yeah.
It's 100% business interruption policy. It's as if they sold a crop, right? So we kind of back into those types of concepts from a dollar standpoint, how we structure the premiums and all that good stuff. But I would tell you that it's like an HSA really for business owners is what one way they.
Oh, I like that
analogy. Yeah, it kind of works, right? Meaning that, hey, if I don't use it, I don't lose it, and down the road, if everything goes well, it becomes another retirement vehicle for me as the owner. That's hopefully the end game of an HSA. And no different than 831B. It should be an avenue to keep your business afloat during those times you own the business. But one down the road, it becomes another asset class. It's always an asset to the shareholders, obviously. And we don't get cute with the ownership. Rhamy, we if you own the company, you're going to own the 831B plan.
If you were to sell the company, more than likely this would be considered basically an asset that would go with the company. Is that what you're thinking?
No, it'd be totally sold separate. Now, what we do see is a lot of times you got business owners selling their business, and then and we call it transactional risk. We'll rewrite the risk, meaning that if you're going to have to hold a note, the rep and warranties that you sold for, now you're being sued because the buyer says, "Hey, this was true. This wasn't. Something happened. Everything's great until."
So you can actually continue the risk mitigation post-sale because it's a separate entity owned by the shareholders.
Yeah, and now they have a bucket of money. So we'll see some guys take some of the sales proceeds, dump them into this, delay the capital gains or dividend taxes on it, keep it tax deferred. So if they do have the ability, to enforce the agreement, or they're being sued over something. And unfortunately, we see that a lot. I mean, we see more and more. I mean, banks aren't financing blue sky, so a lot of times business owners find themselves retaining that.
Right.
Or they get bought out, all of it. Great, good for them. But they're still going to be. We call them carve outs and clawbacks. I mean, that's what happens in every business. You got at least a 3-year kind of obligation of the new buyers to stick around. I mean, so there's a lot of things going, and we kind of fill in where we need to, and we kind of utilize. A lot of merger and acquisition law firms kind of use our services to kind of fill in, kind of look at us as a bond company where it doesn't perform, this money is going to trigger that. A good example would be warranties. A lot of business owners provide a lot of warranties, especially the contract business and the computer guy, everybody building software. I mean, there's a lot of warranties out there. That's an unfunded liability on a lot of business owners today. You go to sell your business, they try to devalue you because of all those warranties.
That's right.
Now you can put these dollars away on a tax-deferred bucket basis. Say, hey, if you have warranty claims for the next 3 years as they run off, you can use this bucket of money. So you're not devaluing my company. So we've really helped a lot of business owners get a
good
premium
one.
A lot of times. That's a smart business.
Yeah.
I mean,
yeah.
You know what I mean? It's
just being able to make that
a smart way of doing business.
So what are the minimum costs then for something like this? So we got kind of a maximum 2.8, 10% of gross revenue, 2% per risk. You wouldn't do that every year, but how does obviously this is a lot to advise on, structure, write, manage.
Absolutely.
So what does that cost?
So it's $6,000 to form one of these plans. That gets you up and running, right? So that forms the EIN. It gets to form the corporation, the shareholders, the EIN number. The domicile setup, all that setup, right? $6,000. That's a fixed cost going forward as well. So the following year, you got to have a tax return done. Our admin fees are part of that. And then there's the domicile fees and all that stuff. So it's an operating company. So it's going to cost you $6,000 a year to maintain it, whether you've put risk into it or not. And it's paid by that entity as well, right? So it's an expense to that entity. Then there's a retained liability fee that we charge. So we share in our clients' risk. Now, one thing we have not talked about, and this is really, if you ask me, you say, hey, man, what's the biggest risk of doing this? Is pooled risk. So one of the things that we do that are it should be unique to us, but we find ourselves being unique to us is what I talked about earlier about the transfer of risk. You have to show the transfer of risk. I pay a premium, I get a policy, I transfer that risk. There also has to be a distribution of risk.
Interesting.
This is where the IRS has won lots of cases. I shouldn't say lots of cases, but when they have won a case, this surrounds this issue. And, insurance is by its very definition is leveraging the law of large numbers, right?
Right.
And, everybody's going to share each other's risk. Some will have claims, some won't. And all those types of things. So what we have to do is if we have a single insured, right? Like, for example, your business. I have one client, you is worried about, let's say, your brand protection. Well, that's a single insured. I have to create the pool in the back room. So we may have 500 companies. It's like, so that it gives us advantage in the marketplace because we are the largest manager of these plans. Our pools are very large. We'll have 500 to 700 operating companies within that pool that has purchased brand protection for themselves. And on the back end of this claim, typically it's about 30%. Let's say it's a max fund claim. Those pools will share in about 30% of that claim. But you have to have that element of risk in order to call yourself an insurance company. How we're showing the law of large numbers. The nice thing is when you have 500 to 700 clients in a pool, and it's all based on pro rata sharing. If I put in $100,000 for brand protection, but another guy only put in 20, well, he's going to own a heck of a lot less of that claim than I will. That's right. Pro rata sharing. But you spread that amongst 500, 700 different participants. Now you've got a lot of spreading of the risk out there, and it becomes manageable. It's a calculated risk at that point, right? But there is no, just because you said it earlier, right? If I don't have a claim, then I get my $200,000 in there. Well, you're going to have claims every quarter.
Interesting.
Because we have 700, 800, 1,000 participants, and we're having claims coming in every week. But what I just literally described to you was insurance.
Right. Of course.
So
in my head, I thought this was a single bucket, but of course, in order to be legally compliant, you have to share risk. So how much of my money is at risk if someone were to ask?
Typically, about 30% unaffiliated claim to you. We run about a 6% loss ratio on an annual basis. It still becomes a very manageable thing. These are dollars you would have gave Uncle Sam anyway, honestly. And now you're able to, that's really, I tell clients, it's a risk, but, because I have clients, well, I don't pay other people's claims. And, sure. and I think it's worth noting that, and I've had this happen with business owners, and it wasn't me that came, but when I heard it, it resonated with me. And it was, hey, if I'm in this pool and a client, if somebody's having this happen to them, I feel like I'm being impactful to that business, meaning, okay, we're all in here together.
Right.
You know what I mean? And to me, it's like, okay, I'm paying a claim that's unaffiliated to me. I get it. I have to do that in order to take advantage of the taxes and deductions and keep those dollars deferred. There is no free ride in the company. There is,
sure.
If anybody tries to sell you a free ride, be careful, right? There's hooks and everything. And I'm being very candid about the hook. The hook is unaffiliated claims to you. However, again, when it becomes down, it's spread amongst many different companies and becomes pretty manageable. Well, at the same time, you're helping business owners out. You hope to God you never have to use this. Honestly. Right. But if you're helping another business owner to get hit because of a brand protection issue, and you got to send him, $50, $100, because that's probably on average what we have claims that are a lot less than that, even for depending on the pools. But that's not a bad.
When I have a claim, is it the same thing? So I've managed to save up $500,000 in this fund. You're writing some limit of insurance of $1 million or something, and if I limit the 500? 2 to 1.
That's another thing you need. Business owners need it. So it's going to be a 2-to-1 ratio. You put up $1, you're going to get $2 in coverage.
Perfect.
And really, our fees that we charge, we retain liability, meaning that if our clients have claims, we're pushing our fees back to the client too.
Sure.
So
as an insurer, it's a general operating
here. Yeah. You know what I mean? We're all kind of aligned where if we win, you win, we win. Those are good things I like the win-wins.
Right.
If they're lose-lose, then you need to lose-lose. I mean, you can't be profiting from somebody that's had a bad year and you keep we don't retain their fees. We push them
Right.
back. And so that keeps everybody, and there's the other thing. We have a fiduciary obligation to the pools now, right? Because you're not going to want to find out that we paid claims that were not a valid claim.
Absolutely.
You wouldn't appreciate that. And, and so that's all keeps everything in balance to me. You know what I mean? That's the checks and balances we have in place. And that's kind of the way when I was building this program, I just, wherever I could apply common sense, we'd try to apply common sense. We're one of the few that we've forced the solvency issue, meaning that you can't just keep piling money away and not having your own. Now, if you never have your own claims, you're probably going to hit solvency. Even if you're pooled claims, you're probably going to hit solvency pretty early. And so that being said, it's like, well, if you're not, we're going to force a distribution. You just don't get to keep putting tax deferred dollars away in this thing. I can see where the IRS gets upset with these things, right?
I mean, because people do it silly. And it's the same with self-directed IRAs, same with people abusing HSAs in certain ways. There are lots of things where the IRS has put out a reasonable guidance that is an advantage, that if you take advantage of it is smart. But that doesn't mean you'd be stupid about it. And people with bad advisors want to go in all the way to where it's not just, it's what the law says. No, it's what matters. It's what actually is happening. It's this insurance, or is this your, personal little fiefdom where you put away $2 million every year on $2 million of income and never pay taxes, and that's not going to work. So have good advisors. Do not get into this without good advisors.
100%. And I would tell you too, that if the CPA or attorney's promoting this to you, I think they know the tax code. I don't think they know risk management. And that's really what's given us we're manageable on our fees, first and foremost. I don't think our mission is to make this a normal business practice.
Right.
And if the client says, well, that's my chance of being audited. We've never had a client get audited due to owning an 831B.
Sure.
It's get audited because they own a business, but not due to the fact they had these plans. Also, we're one of the few managers that have gone through a 6,700 promoter audit with the IRS. And we got our letter this past summer that have released us of our audit, and with no change.
Awesome.
And so, I'm not saying things could change in the future. Who the heck knows?
No guarantees, but
I will tell you, I think I'm feeling very confident where we're at with Congress going into the new session next year. We do need to make this a normal business practice. If there are problems with it, we need to clean it up. We are absolutely, me being an entrepreneur, first and foremost, I hate regulations. But honestly, in this situation, I am for more regulations if that's going to make this more normal business practice. Because
clarity,
because the stress of traditional insurances it's coming, and it's getting worse. I mean, we're seeing actual cash value now on roofs.
I've been seeing that.
If you depreciate a roof down 20 years, you're not getting anything for that roof when it blows off due to a hurricane.
Yep.
You're self-insuring. More and more business owners are finding themselves self-insuring more risk, even under traditional channels. Not only the complication of running a business today, where we're so intermingled. Third-party business interruption, to my knowledge, we're the only ones that have written a policy for third-party business interruption, because it's huge today. It is huge. It's one of the, and you don't think about it until it happens. And by then it could be too late, unfortunately.
Well, Van, if our listeners I think they've gotten a great overview, a lot of good information. Where should what are their next steps if they want to learn more? How should they get a hold of you? What should they be looking at?
Yeah, I would encourage them to reach out through us, our website. We own 831b.com. It's designed to educate and really bring you up to speed. And here's what I would say, Rhamy, this is another tool in the toolbox. It's all it is. It's not a silver bullet. I kind of describe why it's not silver bullet, with the sharing of claims.
Sure.
But at the same time, though, I think it's, for the right clients, a great tool. And so it's like anything else. You owe it to yourself. You owe it to the business. You owe it to the risk you've taken. You owe it to the employees you help support. To look into all tools that are available to you, and how do you maximize those tools? Because your competitors are, and I will tell you that, and I've seen that.
I think that's a really good point. Being able to, this happens all the time, is figuring out how to do something for the future and not get dinged for it right now. Because that if you as a company say, look, I want to save up $100,000 a year to cover, in this case, it's a risk, but an expansion, all those things,
Yeah.
you got to pay, you're going to sock out 38% of it right now. And it's really difficult. So this is an excellent avenue for that. I highly recommend everybody check out 831b.com. Van is the founder on there. Fill out information. Is there a form on there
There
to
is.
get in touch?
And if they want to email me, it says van@831b.com. So,
There we go.
Our info@831b.com. Any of those things. And then too, there is a contact us page. There's some videos on there, some animation videos that, I'm told that grab people's attention. So I'm hoping they work.
If you have any questions about this stuff, I want you to write it down in the comments, everybody. We'll be forwarding them along. We'll make sure Van and his team hear about them. I appreciate you so much, Van, for educating our audience and spending some time with me. If you ever need anything, you let us know. In the meantime, everybody else listening, it's time to go out there, have a great day, and get your work done. Check us out. Subscribe, like, share if you think this would be interesting, and make sure to reach out to Van at 831b.com. Y'all have a great one.